Rohr here with an early global view on Wednesday, October 8th, 2014. It's currently 6:45 a.m. U.S. Central Time, and it's quite an extensive view today because there's a lot of macro background affecting these markets. So now we need to look at how this has actually been reflected in the markets. And what we saw yesterday was weakness in the S&P 500 right from the gun. And the most interesting part is that the market was immediately back below the 1945 level. As you know, we have been looking classically, both when the market's been above it or below it for quite some time. At 1955 to 50 is a key technical zone, but with a tolerance to 45. Much as we saw when the market experienced its weakness going back to last week Wednesday and got right near there, tried to hold up, but when it couldn't hold, took a bigger spill. Well, starting the day below 45 yesterday did not really quite put in the down break out of this rising channel, the current short-term channel up from the 1918 area low going back to last Thursday in the wake of the negative response to the ECB's lack of aggressive quantitative easing implementation, and the other questions which surround that, which are all part of that commentary that we put out yesterday and we suggest to read. But now we're looking at market having been below 50 to 55 and below 45 that finally did break down in the second hour yesterday by closing below the channel from 1948.5. So that's reinforcing resistance anywhere back up near 1950, and the reinstatement of this 25% retracement that was set up when the market hit the low last week at 1918 means you're going to have earlier resistance, also coordinating with the failed Fibonacci 2/3 here right around the 1941 area. So we'll be keeping an eye on that. Lower supports are 1920 area into the low at 18, which is important for other reasons than just being that low, with the bigger supports being down in the 1900 area to roughly 1895 off of the previous test in that area that gets all the way back to the late May gaps higher. Now, on a technical level, one of the things that is going to reinforce the bears, unless there's a stronger rally than just a temporary kick back up to this 1940-41 area, which is also near-term congestion, an overrun gap here from 1938, etc., is the degree to which the hourly MACD later on yesterday got out below and remained below the lower runaway band at the finish yesterday. So this also would allow for a swing back up, potentially to no better than 40, 41, or even 48, that would not take away the downside momentum. Much above that, we presume this hourly MACD might be back above that lower runaway band and speak of a market that could improve further, could maybe get right back up into the 1970 area, and we shall see. That pretty much does it for the short-term view of the S&P 500.